Welcome back. In the previous video, we covered inflation and real rates of return. In this video, we get to the true focus of Chapter 5, which is to make the world more realistic, and then determine whether our simple rules from the first 4 chapters still apply. Our questions will be pretty much the same as always. What is an asset worth? Should you undertake a project? How should you finance it? Our big change in this chapter is that we no longer assume that the cost of capital, that is the interest rate, is the same for every horizon. A 1-year interest rate can now be very different from a 10-year interest rate. That is annualized, of course. What do we need to change about our methods if annualized interest rates depend on the horizon, or, as finance people call it, depend on the term? Of course, this may also matter to you personally. If you buy a certificate of deposit at your local bank, the interest rate that you get will differ based on the term. Now, there is no reason to assume that interest rates should be constant over all horizons. Different interest rates over different horizons have a long history. For example, in medieval times, farmers wanted to store their savings in fall after they'd sold their harvests. In summer, just before the next harvest, they were more likely to run out of their reserves and wanted to withdraw savings or borrow more money. Thus, the interest rate used to be lower in fall than in summer. Of course, agriculture is no longer the main driver of today's economies. But there are still times in which demand and supply for capital are different. There are still times when investors are more eager or less eager to commit their capital for shorter or longer periods of time. You need to learn how to operate in a world in which this is the case. Here are our assumptions again. Perfect capital markets. No differences in opinion, no taxes, no transaction costs, no big sellers or buyers. Still, perfect certainty. The thing we're taking away now is equal annualized rates of returns per period. Treasuries are obligations issued by the United States Treasury in order to finance the US deficit. They can be named Treasury bills when they're short-term, Treasury notes, or Treasury bonds. This is really all the same thing. It's just the time period is different. I sometimes say Treasury bond when I really mean Treasury bill. US Treasuries are the most important financial security in the world. Issued, that is denominated in US dollars, they offer risk-free dollar returns. The Treasuries market is also very close to perfect. The transaction costs are extremely low, definitely for traders, actually also for retail investors in most cases. There are very few opinion differences. That is, there are very few people who have inside information, and the ones that do, like the chairman of the Fed, is not allowed to trade on it. They're very deep markets. There are many, many buyers and sellers. And the income taxes, though they depend on the owner, many of the relevant holders are tax exempt. And certainly for them, the Treasury market is practically a perfect capital market. And there's almost no uncertainty about repayment. Well, almost. It turns out that Washington has gone crazy, so sometimes the various House, Senate decide that they don't want to fund the deficit that they have created. And then the Fed has to issue IOUs and really strange things happen. Usually there should be no uncertainty. The US government can always issue more bonds in US dollars, and they can always print more US dollars. So there should be no issue here. Now, how big was this market? For comparison, US gross domestic product was about $26 trillion. Outstanding in 2022 were about $23 trillion in US Treasury securities. That's the equivalent of about $70,000 per citizen, or about $150,000 per employed person in the United States. So The government has taken loans on your behalf, on everybody's behalf, already over $150,000, and it's not stopping. US Treasuries were not the only outstanding fixed income security. Mortgage bonds, that is, bundles of mortgages, my mortgage, for example, bundled together with many others, are about $12 trillion. Corporate bonds are another $10 trillion, and municipal bonds another $4 trillion. Together, the fixed income market, bonds, loans, is about $53 trillion. Annual Treasuries trading is about $150 trillion. That means it turns over about 5 times. This is close to $1 million per every US employed worker per year. It's an enormous amount of trading. The yield curve is the most important part of finance. It is the plot of annualized yields on the y-axis against time to maturity on the x-axis. The US Treasury yield curve is the most widely watched financial statistic in the world. So, remember how to calculate annualized rates of returns. If the 2-year zero bond promising $100 costs $80, then the 2-year interest rate is 25%, and the annualized 2-year rate is 11.8%. And the yield curve basically on the number 1 may have a particular number, 11.1%, and then on 2 would have 11.8%. You can download a US Treasury's yield curve from many different sources, such as the Treasury website, and here are the URLs, or in CSV also from the Treasury website. And remember, the yield curve is really annualized internal rates of returns. So, in 2016, this is how the yield curve looked like. If you looked at a Treasury bill about 1 month left to maturity, it had a yield of about 0.5%. Over 1 year, it was about 1%. Over 10 years, it was about 2.5%, and over 30 years, it approached 3%. That was at the end of 2016. 1 year later, this is how it looked like. The yield curve was a lot flatter. That means short-term rates were a lot higher and long-term rates were lower. What about the following year? Well, that year, everything looked sort of flat, was a little bit higher than before, but there wasn't such a steep difference between short-term rates and long-term rates. How about 2019? 2019, it had dropped again, although at the far end, it still went up a little. 2020, look at this. Let me show you again. All of a sudden, it dropped like crazy. For the first 3 years, the interest rate was almost nothing. This was the year of COVID. At that time, the Federal Reserve flooded the market with liquidity. They just gave everybody money to borrow at almost no interest rate, including to the US government. It was only further out in the distance that interest rates were positive again. Following year, well, the short rates were still very, very tiny. It was still COVID. We were just slowly getting out of it at the end of this year, but the 30-year already was much further. Whoa, look at this, 2022. At this point, we had the supply crisis. So 2021, 2022, dramatically higher, 4%. At this point, the Fed had abandoned its easy money policy, and even the US government had to borrow at 4%. End of 2023 went higher yet. The Fed was now getting really worried about inflation and really tightened its monetary policy. 2024, it stayed pretty high, 4.5%, very flat. Look at this one. This is a very old yield curve from 1980. Look at the numbers on the y-axis. This is not a typo. For a 1-month Treasury bill at that time, you could earn a rate of return of 19%. 19%. A huge amount of money. Over longer periods, however, then it was not as steep anymore. It became less and less steep. So over 10 years, it was down to 13%. Still huge by today's standards. There are many variations on the yield curve in use in the real world. You can easily view them on the World Wide Web. For example, people do curves like this, but also with TIPS, or with munis, or with German bonds, or with corporate bonds, many others as well.
Please pause this video now, answer the question on a piece of paper, and then continue.
So what are possible Treasury yield curve slopes? Can it be flat? Go back. Yes, in 2018 and 2024, it was just about flat. Can it slope up?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yeah, we had that too. This is the most common yield curve slope. For example, we had that in 2016. If the yield curve slopes up in a perfect capital market, is a 30-year Treasury bond with a higher interest rate, say 5%, a better deal than a 3-month Treasury bill with a lower interest rate, say 0.1%?
Please pause this video now, answer the question on a piece of paper, and then continue.
Neither. Come on, guys. This is among the most competitive markets in the world. There are no great deals or bad deals to be had here, only fair deals. Unless you are dealing with a loan shark around the corner and are paying stupid rates, these are fair rates. You get a fair deal transacting at the normal prices as they are quoted in the market. Can the yield curve slope down?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yeah, of course. We had that. In 2023, it sloped down. In 2022, it humped and then sloped down again. And of course, the really crazy one that I showed you from long, long ago definitely sloped down like crazy. Are there yield curve slopes that could imply arbitrage in principle?
Please pause this video now, answer the question on a piece of paper, and then continue.
In theory, yes. For example, if the interest rate were 10%, followed by minus 5% the following year, you would get a yield curve with the annualized slopes from 10% to 2.2%. This would mean somebody is paying you in the second year minus 5% for your capital. They would give you money to take their money. Of course, in practice, this doesn't happen. Nobody is giving you free money. But there are yield curves that should be impossible. The most common yield curve shape is upward sloping. There is no repayment risk for US Treasuries, and yet we see usually upward sloping yield curve. It can't just be fear about future repayment. Why is it upward sloping? Hold your horses, we're going to do this in the next video. This course is corporate finance. So, from this perspective, we get certain lessons. Perhaps the most important aspect of these yield curve are also the simplest ones. If investors are willing to pay less or more per year for long horizon treasuries, presumably they wouldn't be too thrilled to give us capital at very low prices or very high prices for our long horizon projects too. And as their managers, this should make us less inclined to take long horizon projects too. Formula-wise, everything we've done before really holds. The only difference is we now have to spell out the interest rates. So 1 plus r 0t is no longer just 1 plus r to the power of t. We need subscripts, one for each period. This can become very painful, but it's just notation. It's not surgery. The rate of return is really the same. It's 1 plus r03, and now we have to have the two individual subscripts on each year on the following three factors. Remember what one subscript on an r means. So in this case, we can just omit one of the two subscripts on all the factors on the right, because this is just the common abbreviation. NPV is really just the same thing too. And you can write it out with the R2 subscript or with the R1 subscript. It doesn't really matter. You can also write it out as general formulas, and then it becomes even more painful. But the principle is really all the same. What about financing when you are dealing with term varying yield curve? Term varying means you have different rates according to term. Well, the yield curve matters not only for what projects we want to take, but also for what kinds of financing we may want to issue and what rates we may need to pay. So in the real world, we individual and corporations have to pay higher interest rates than treasuries, but what the treasuries do anchors our own borrowing rates. This is so even in a perfect capital market, and it'll be the subject of the next chapter. A project of X years for us is not simply the same as investing into X consecutive one-year projects. They're different animals. Longer-term projects can require different, usually higher costs of capital. The fact that longer-term projects may have to offer higher rate of returns could, but need not be due to higher risk or lower liquidity. Even default-free treasury bonds typically offer higher rates of returns for longer maturities, and there is no risk and no liquidity problems. This is sometimes called the term premium. It's not liquidity, it's not risk. If you need liquidity, individual investors can always resell their bonds anytime when they need cash. There's no requirement that you hold it until it's actually paid off. Of course, for us, long-term projects are also often riskier. We've assumed no uncertainty in this chapter. In real life, who knows what the future will hold? Longer-term projects in the real world often have more chances to run into trouble. And this extra uncertainty over longer horizons is the reason why long-term projects also often higher rates of returns in addition to the standard term premium that even risk-free treasuries have to offer. One more thing. We're going to have to cover duration. That is not a measure of implied profitability, but sort of telling you an average time when the repayment is going to occur. It's very commonly used with bonds, but it's also quite useful for thinking about your own projects of all different kinds. For example, Project 1 may pay $200 in 1 year and $100 in 4 years. Project 2 only pays $300 and in 4 years. They have the same maturity, 4 years. However, clearly the payments for Project 1 come due earlier than the payments for Project 2. So what we want is some sort of measure that tells us Project 2, 4 years. Project 1, well, looking at that, maybe 2 years. Somewhere in between 1 year and 4 years. Here is our measure of duration. You take the dollar amount in each period and you multiply it by the time index, the year index in this case, 1, 2, 3, 4. And then you divide that number by all the payments together. If you do this, the number that comes out is 2. You can also think of this as a time-weighted payment, payment-weighted time. So the number 1 is multiplied by 2/3. The number 4 is multiplied by 1/3. This is why you get 2.0. Now, An even more common measure than duration in the real world is Macaulay duration. And that is almost the same thing as plain duration, except it uses the present value of the cash flows instead of just the cash flows by themselves. So doing the same numbers as the previous example with a discount rate of 10%, we would just divide by 1.1 each. And that gives us 1.82. Please make sure that I calculated this correctly. Macaulay duration tilts a little bit more towards the front because front cash flows are relatively more valuable. They are not discounted as much. That's it for this video and for the basics of term-dependent interest rates. In the next video, we'll ask some broader and more conceptual questions. Not what do we do if the term structure is sloping, but why is the yield curve sometimes upward sloping, sometimes downward sloping, and what does it really mean for investors in the economy? See you soon. Bis bald.
Tell me what an economist, a plumber, and a garbage disposal worker have in common.
They're all jobs for real men.
Oh, I see. Only to the extent that they all handle the gross domestic product.